All you hear in the headlines right now is about a commercial real estate crash. But honestly, the real story, the one that's going to matter for serious investors, is kind of buried in the data. What's coming isn't really chaos. It's a predictable, massive repricing event. And for anyone who's prepared, it could be a once-in-a-generation opportunity. So today, we're going to break down the strategy behind what people are calling bottom fishing in 2026. This right here, this is the whole game. Forget the panic. This is about a huge, predictable shift in value. We're talking trillions of dollars in property that was bought and financed in a totally different world, and it's all about to be repriced for the world we live in now. This is creating an opening for investors that we just haven't seen since the last big downturn, over a decade ago. Okay, so first things first, let's frame this the right way. We are not talking about some vague prediction or a guess about market sentiment. No, we're looking at an event that is already locked in, and it's all being driven by the cold, hard math of debt that's coming due. This is the anatomy of a generational wealth transfer.
So what's the right way to think about this? Well, the word crash sounds emotional, right? It sounds chaotic, unpredictable. But a repricing, that's exactly what's happening. It's a logical, data-driven adjustment. The value of these properties is just being recalculated based on the new reality of way higher interest rates. Shifting your mindset from that emotional crash frame to an analytical repricing one, well, that's the very first step to seeing the incredible opportunity here.
This illustrates the strategic shift perfectly. Just last year, in 2025, the whole vibe was wait and see. Just passively watch, hope for some clarity. But 2026? Nah, that demands a totally different, proactive approach. The new mindset is look and act. It's about actively hunting for the assets that are going to face distress, not sitting on the sidelines waiting for the news to tell you what's already happened. So what's the engine driving all of this? Well, it's a phenomenon that analysts have literally had circled on their calendars for years. They call it the Great Refinancing Wall. And understanding this one concept is the key to unlocking everything, both the core of the problem for the current owners and the core of the opportunity for new investors. Just look at that number for a second. $1.8 trillion. That is the amount of commercial real estate debt that has to be refinanced between now and the end of 2026. It's a truly staggering amount of money that's about to run smack into a brick wall of higher interest rates.
And here's the critical piece of context for that trillion-dollar figure. This isn't just any old debt. The vast majority of it was created between 2019 and 2021. You remember, the era of practically zero interest rates. So property owners, they locked in these huge loans at historically cheap rates. We're talking 3, maybe 4%. Now they have to go back to the bank to refinance, and they're facing a new world of 7, 8, maybe even higher percent rates. And that changes everything.
This chart shows you exactly what we're talking about. The loans coming due in 2024 and 2025, they were manageable. But look at that spike for 2026 and 2027. That is not a hill, it is a sheer cliff. It's a tidal wave of debt that all needs to be refinanced at the same time. And remember, this isn't some hypothetical forecast. This is a fixed schedule. These loans are already locked in and they are barreling right towards us.
Okay, so we've seen the massive macro problem, but that's kind of the 30,000-foot view. How do you actually spot the distress at the individual property level? Well, you need a simple, powerful litmus test to instantly figure out if a property is financially healthy or not. And it all comes down to one critical metric.
This is it, the debt service coverage ratio, or DSCR. You can think of it like a property's financial pulse. It's vital signs, and it's not complicated. It just asks one simple question. Does the property's income, that's the rent you collect minus your operating expenses, comfortably cover its mortgage payment? And the lenders, they have a golden rule. They will not even talk to you unless this ratio is 1.25 or higher. That means you need $1.25 of income for every single dollar of debt you owe. That little 25-cent cushion, that's non-negotiable.
This table just makes the whole DSCR thing crystal clear. Okay, look at the left. We got a property back in 2021. It's making $150,000 in net income, and with a nice low 3.5% interest rate, its annual debt payment is $118,000. You divide the income by the debt, you get a DSCR of 1.27. Healthy. The bank is happy, the owner's happy. Now, fast forward to 2026, on the right. Notice the most important part. The income is exactly the same, but the owner has to refinance into a new 8% loan. Suddenly, the debt payment more than doubles to $264,000. And that DSCR, it plummets to 0.57. And just like that, a perfectly healthy, income-producing property is in technical default.
So we've figured out the big systemic problem, that wall of debt, And we have the tool to spot it on a single property, the DSCR. So the next logical question is, where do we actually find these opportunities? Where do you go fishing for these distressed assets?
As the legendary investor Howard Marks says, you want to fish where the waters are less crowded. The biggest returns are almost never found where everyone else is competing for the most obvious, perfect-looking assets. Nope, they're found in the assets that are overlooked, misunderstood, or just flat-out ignored by the big institutional players.
And this really highlights the crucial difference. On the left, you've got your Class A properties, the shiny, new glass towers in the best parts of downtown. They're owned by massive pension funds. They are already perfectly managed. But on the right, you have Class C properties. These are older, maybe a bit worn down, and often managed kind of poorly by smaller owners. And you know what? That mismanagement is the opportunity. See, the crucial point to get is that in this kind of environment, you have to create your own value. With these Class C properties, you can force the appreciation. You can do it with smart renovations, by bringing in professional management, by raising rents to where they should be. You aren't just buying something and crossing your fingers hoping it goes up. You're buying a business plan. You're buying a project with massive upside that the big guys who are focused on perfection, they just can't see or frankly can't be bothered with.
Okay, now before we put this all together, let's talk about a huge, costly trap that a lot of retail investors fall into during times like these. Understanding this is absolutely key to protecting your capital.
Here's the question that sucks so many people in. They see a real estate investment trust, a REIT, and its stock price is way down, but it's boasting this huge, juicy dividend, 10% or more. It looks like an incredible bargain, like a can't-lose situation. But is it? More often than not, a crazy high yield like that isn't a green flag. It's a massive red one.
This is the brutal truth, and it plays out like a series of dominoes. An investor sees that shiny high dividend, and they just don't do their homework. They don't look at the REIT's balance sheet, specifically its debt maturity schedule. So when that REIT's mountain of debt has to be refinanced at much higher rates, all that cash flow that was being paid out as a juicy dividend, it suddenly gets diverted straight to the bank just to keep the lights on. The dividend gets slashed or maybe eliminated completely, the stock price collapses, and the entire reason you bought it in the first place is just gone.
So, let's bring this all together into a strategic mindset. We've defined the big picture problem, we've learned the essential tool for analysis, we've identified where the opportunity is, and we've flagged the big trap you have to avoid.
So here it is, the 2026 Investors Playbook in 3 simple steps. 1. Understand the storm. That wall of maturity isn't a guess, it is a scheduled certainty. 2. Master the test. Get fluent using the DSCR calculation so you can instantly spot financial distress. And 3. Fish in the right pond. Focus your time and your capital on undervalued, mismanaged Class C properties where you can actively force appreciation and create your own returns.
At the end of the day, all of this comes down to one simple, timeless truth in investing. Periods of widespread distress are the moments when generational wealth gets transferred from one group to another. And the predictable repricing of commercial real estate over the next couple of years, it's set to be one of the biggest events of its kind since 2008. The only question left isn't if this opportunity is coming, but will you be prepared when it arrives?